Hi, welcome to the revenue recognition chapter. Hugely important topic. We will learn the basics and give you revenue recognition skills for 90% of the clients, companies you're going to encounter in terms of their revenue recognition under their business model and their particular contracts. You'll probably revisit the revenue recognition in your curriculum with very idiosyncratic transactions, more elegant transactions later. You will also deal with revenue recognition questions and issues in your practice frequently. So we're going to provide you with a real solid foundation. This is an introductory video. And here's what we're talking about. This journal entry, accounts receivable or cash would be the debit, and then sales revenue is the credit. Oh, looks nicely obvious, doesn't it? Well, two questions arise that may be quite simple, but in some cases are quite complex. The first question is, when did that company earn the revenue? What day? The second key question is, how much revenue did the company earn at that time? So both the date and the amount of this transaction are usually obvious, but not always. Let's proceed with our introduction of these issues. So what is revenue? Revenues are inflows or other enhancements of assets of an entity or settlements of liabilities from delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. Again, there are two issues to consider: how much and when. The guidance for this important determination is provided by Accounting Standards Update 2014-09, Revenue from Contracts with Customers, which is, of course, now codified in the FASB codification. So here's an introduction to revenue recognition. Companies recognize revenue, and this again is the core revenue recognition principle. Companies recognize revenue when goods or services are transferred to customers. That's the when. For the amount the company expects to be entitled to receive in exchange for those goods or services. So do some highlighting, some underlining for those, because that's the core revenue recognition principle. But of course, the devil's in the details. What are the 5 steps a company follows to apply the core revenue recognition principle? Step number 1, identify the contract with the customer. And this contract can be implicit or it can be written. Step number 2, identify the performance obligations in the contract. Step number 3, determine the transaction price. Step number 4, allocate that transaction price to each performance obligation. This is, of course, only relevant when the contract includes multiple performance obligations. You'll see some examples of that upcoming in our discussion in this module. Step number 5, recognize revenue when or as each performance obligation is satisfied. That is, when the asset delivered and control assumed by the buyer or service is completed. The performance obligation of the seller. The contract can certainly contain one or more performance obligations for a seller. The performance obligations are usually obvious And we'll deal with several obvious ones before we look at some that aren't so obvious. Transfer is considered to have occurred when the customer has control of the good or service. Control means the customer has direct influence over the use of the good or service and obtains its benefits. Let's talk about some examples, some rather simple examples that you'll be familiar with so you have context to think about these transactions. You buy a cup of coffee at Starbucks. You buy a broom at Target. You buy a book at the university bookstore. And the question is, what is the performance obligation in the sales contract, and when is the performance obligation satisfied? So please pause for a second and answer these and then return. Okay, welcome back. Here's my response. You buy a coffee at Starbucks. The Starbucks performance obligation is considered completed when they provide you with your cup of coffee and you accept it. Similarly, when you buy a broom at Target, Target's performance obligation is satisfied when you are able to take the broom to the checkout counter, check out, and then walk out of the store with it. Same answer with buying a book at the university bookstore. Okay, and that's a quick introduction. So the key points for the introduction is, what is the core revenue recognition principle, and what are the 5 steps that we follow to apply that core revenue recognition principle? In upcoming videos, we're going to use these steps in various scenarios. Thank you for your attention.